When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave Chase and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Income, legacy, growth. It's all right here at ILG Financial, and it's about helping you plan for retirement your way so you can achieve your financial goals. I'm Ron Stutz along with Dave Lopez of ILG Financial. Hope you're having a good day today. We appreciate your being with us here today, and we're going to talk about some really interesting topics. Really quickly, let me give you Dave's phone number if you'd like to get in touch and have a conversation with him. It's 540-720-5656. 540-720-5656. Or, of course, anytime you can go online to ilgfinancial.com to learn more. First of all, Dave, how's it going for you?
Going great. It's depending on when you're listening to this podcast, this may make perfect sense or no sense. But it's nice that spring has sprung. How about that?
I agree with you about both of those things.
So that's the beautiful thing of a podcast, right? So if anyone's down in the dumps about winter, save this podcast and then turn it on in December when it's dark at 4 o'clock and you can start to feel better about knowing there was a time when we were excited that spring was here.
You know, Dave, for decades and decades, we've all heard and seen bank commercials on TV that end with an announcer's voice saying, "Member FDIC." Mm-hmm. And for the longest time when I was young, I didn't know what member FDIC meant. If you would take just a moment and tell us exactly what FDIC is, because that's the topic of today's conversation.
Yeah, and that's a great question because a lot of people hear that and all they think is like, I think that means my money's safe. Mm-hmm. The FDIC is a independent governing agency, and it was created by Congress after the Great Depression. And the goal of the FDIC, when it was implemented, was to help restore confidence in the bank system. So you'd have to go all the way back to the banks closing down in the Great Depression.
Right.
And having FDR step in and say, we need something else. People aren't going to use the banks if they feel like if a bank goes under, your money's all gone. So that's the purpose of the FDIC. It generally covers, and this is what today's podcast is going to be on, up to $250,000 per depositor. Mm-hmm. Okay, so if you put your money in the bank, Ron, and the account's under $250,000 and that particular bank goes under, this government agency, Federal Deposit Insurance Corporation, this FDIC, will step in and guarantee your money up to your account value as long as it's no more than $250,000.
Okay. So now we have a basic explanation of FDIC, Federal Deposit Insurance Corporation. And there was an article that came out in early April that says some of the rules that protect wealthy savers' bank deposits just changed. Now, Dave is here today to dig into this news about the FDIC changing some rules and what it might mean for you. So, Dave, tell us what this is all about, if you would.
Yeah, so there's been some would call minor changes, but they're important changes. And the goal here of today's podcast is for everybody listening, it's important to make sure that you understand exactly how much of your total bank deposits are insured by the FDIC and by connection to that by the United States government, right? So what we're going to do today is we're going to walk through these changes to what's covered under FDIC and kind of talk about it and make sure we have a good understanding at the end of this podcast.
Okay, well, tell us about these changes, what they are, what they mean, and how they might affect an individual who's listening to this podcast.
Sure. So the FDIC made changes that were effective April 1st, 2024. So as of this recording, they are now in effect. And as I said, before April 1st, we all knew we had up to $250,000 in bank deposits guaranteed by the federal government. And that's still the case. What we're going to talk about are some differences in how they describe, if you have multiple accounts, for example, what happens and how they define multiple accounts. Okay, so these changes could push some folks, Ron, to a position where they thought they had all their money covered and now they're not. So we want to be very clear. We've got basically, we're going to hit about 3 or 4 points, and let's just jump right into it. So the first one is with respect to trust, but let me start by saying, when you're told that you have up to $250,000 in protection at a bank, Ron, by FDIC,
Yeah.
that's $250,000 per account holder, right?
Okay.
So that means if you have 4 accounts in your name, you don't get $250 per account, you get $250 for the total of the 4. Does that make sense?
Yeah, very important for people to understand that.
Very important. So you can't get extra protection just by splitting the money into separate accounts. Now, the exception to that, and this is what we're going to talk about, is they've always made exception to different types of accounts. And for today's call, we're going to separate it into several types. One is an individual account. So that would be an account in your name, Ron, an individual account in your name.
Okay.
A second type of account, which has its own coverage protection, would be a joint account. Okay, so if you have an individual account and you also have an account with your wife, Ron, then that means you get $250 in coverage in your account, and you'll get $250 in the joint account, and your wife will get $250 in the joint account. So between you and your wife, with those 2 accounts, you would, in theory, if it was set, the money was in the right places, have up to $750,000 in protection. Make sense?
That makes sense.
Whereas, if you had in fact that $750,000 in 3 individual accounts in your name, you'd only have $250,000 in protection.
Yeah, I understand.
Okay, so one group is individual accounts, one group is joint accounts. The third group would be trusts. We're going to spend a little time on that. And then the fourth group that we'll talk about very briefly would be if you have a small business or a business and it was an account in a corporation's name. But mainly for today, we're going to talk about the first 3. Sound good?
Okay, yeah, perfect.
Okay, so let's start by saying that the difference, individual accounts are pretty straightforward. Are you comfortable with that?
Yeah, that sounds good to me.
Yeah, and same with joint accounts. So they made a change to the definition of what they consider a trust account. Now, before this rule change, you could have the trust split into different types of trust. You could have a revocable trust, which is a trust that you can change anytime you want. And you could have what's called an irrevocable trust, which is a trust where you don't have the authority to change it. Okay. And which one's right for you is a whole another podcast, right? But before the April 1 change, you would have coverage. If you had a trust, irrevocable, and a revocable trust, each one would have their own protections. The new change changes that, and they say we're grouping all of your trusts, irrevocable and revocable, into one group, just like we did earlier with multiple individual accounts.
Okay.
Okay. So what they're saying now is for all of your trust, as the trust owner, you get $250 in protection for the trust per beneficiary. So you may be the owner of the trust, Ron, but if you had your 2 children were the beneficiaries, your trust would be covered up to $500,000.
Oh, okay. All
right? If you had 3 kids, up to $750. Get the idea?
Yeah, that's
right?
That's
nice.
Pretty
right?
easily explained. Yeah.
Yeah. Maximum 5 beneficiaries, which means the most coverage you can have as an owner of a trust is $1.25 million.
All right.
Remember, the thing we want to take away from this is that's for you as the owner of the trust, but that's your coverage for all of your trusts.
All right.
Right? Not per trust. Okay, so you may have one trust with $1.25 million in it and 5 children as beneficiaries. All of it's covered.
Okay.
I
suppose there has to be an upper limit somewhere.
Yeah, it has to be, right? You may have a second trust revocable or irrevocable. Now it doesn't matter, right? That other trust, in effect, none of it's covered because it's a $1.25 million per trust owner.
All right.
So we're grouping them. So that's one of the changes. How can this affect you, right?
Yeah.
Well, since this is a change, under the old rules, if you had in this example 2 trusts, you may have had more coverage than you do now.
I can certainly understand that, yeah.
Right. And this can be a real problem. It's not really a problem really with individual savings accounts or checking accounts because you can just move money around if you need to, correct? Mm-hmm. Where it could be a problem, though, is if you're tied into, say, a 5-year CD with $2 million in a CD and you thought you were covered. Now you're not. You may have to pay a penalty to get out of the CD if you want to move the money around. So this is the purpose of today's podcast, is to make you aware of that. Know these limits that we're giving you today. And if you think you're over the limit, get with your bank, right, or get with your financial advisor and see if there's something you can do or something you might want to change if you want to get back below the government's limits.
Okay, these changes may cause coverage reductions for certain investments that were established before the changes took place. Mm-hmm. So I guess, some things, is there a matter of anything being grandfathered in here, or how does that work?
No, and that's the challenge, right? It's just the rules are the new rules. Mm-hmm. So you'll have to, the onus is on you as the account holder to make changes to your account if you want to stay within the new limits mm-hmm. of what's covered.
So I understand you may not be able to close the account or change the account until it matures. So, how do you deal with that? Well,
you'd have to talk to the bank. The bank, because of these new rules, they may give you an exception on your CD, mm-hmm. right, and let you get out without a penalty, especially if you're going to move it into another account with them. But if they don't, you have to weigh paying the penalty to make the move or staying in the account and just knowing you're taking on more risk in case of a default by that bank.
Okay. So it's kind of up to the bank whether they would do that, right?
That's right. And the takeaway from today is just know this change has happened, and it probably is, if you're near the limits that we're talking about today, it's going to warrant a phone call to the bank that you maybe have now exceeded the limits.
Okay. Tell us about the next change that we're talking about here in regards to FDIC.
Okay, so again, not a big change for individual accounts and joint accounts. We talked about that. So far, what we talked about is they used to have a grouping for revocable trusts and a separate grouping for irrevocable. Mm-hmm. They've changed that rule that said all trusts are now considered one group, which, again, could lower your coverage because if you had a revocable and an irrevocable trust under the old rules, you would get coverage as an account owner under both rules, under both accounts. Now they're grouping them into one pile, and you just get a maximum of $1.25 million, and that's only if you have up to 5 beneficiaries total.
Okay.
So it's up to $250 per beneficiary, not to exceed 5 beneficiaries.
I'm always fascinated when the government decides to change something like this. What brought this about? I mean, why did they decide to make these changes?
Well, these in particular, I think it's just somebody got a bee in their bonnet and said, let's just be clear and make sure. But usually it's because somebody takes the definition and it has unintended consequences. Mm-hmm. Right? And they look at it and they say, listen, these people have more coverage than we had actually intended for them to have.
Right.
So let's just clarify things. So that's how I see this rule, is they're just clarifying things so that they can put some better limits on what's covered and what's not covered.
You're listening to ILG Financial's Retire Your Way podcast with Dave Lopez, the founder of ILG Financial. And we're talking about some of the changes to FDIC, Federal Deposit Insurance Corporation. And are there any other changes that we need to know about?
Yeah, this is the biggie that might affect most of the folks listening today, is if for any of you that have an individual or a joint account, and then you've added a pay on death form to the accounts, that's a way to add your heirs as beneficiaries to the form. Mm-hmm. They said just by having that form filled out and listing the beneficiaries, they now will count that account not as an individual account or a joint account, but as what's called an informal revocable trust. So it's now grouped into the trust category.
Right.
And again, that's not necessarily good or bad, and it doesn't necessarily limit your coverage on that account. In fact, it may actually give you a little more, right? But it's different for everybody. If you already have used up the maximum coverage for trusts and you thought that your individual account was separate, even though you had a pay on death form, now that's not the case because it's going to be grouped with the trusts.
Okay.
Right? Likewise, if you had two individual accounts and one of them has a pay on death form, you actually now have more coverage because one's going to be covered under the rules for trusts and one's going to be covered under the rules for individuals. So make a note, if you have any of your accounts with a pay on death form, that it will now be considered under the trust rules, which is up to $250,000 in coverage for you as the account owner.
Right.
Per beneficiary listed on the POD form, not to exceed $1.25 million for all of your trusts.
My head is kind of spinning with all these changes here. But so basically the bank no longer has to have payable on death in the title on the account or in their records at all, as long as the beneficiaries are listed somewhere in the bank records, right?
Yeah, that's a great way to put it. So this was kind of already the rule if you had on the account listed Dave Lopez, and then it said also pay on death account, then it was already considered to be in the trust group. Now they're saying it doesn't have to, that's not necessary. If you filled out a pay on death form and the bank has it on file, it's considered to be in the trust group. Now that's an important one because most folks probably didn't know that. They probably said, hey, this is a joint account in me and my wife's name. We've added a pay on death form just to make sure the kids could get into these accounts immediately if we passed. But we didn't know that that somehow might affect the FDIC coverage. And it does. And again, it might affect it for the better. You just want to reach out to your bank and find out.
Okay, so with all these changes in regards to FDIC, are there options? Are there things that people can do to avoid problems that might result from these changes?
Sure. There's a couple. The first one is the one that most people are familiar with, which is understand the rules and make sure you don't have more than your $250,000 limit across each of the accounts that you have the availability to have that limit. Mm-hmm. You don't want more than that in one account. So, for example, you could have no more than $250,000 in coverage in an individual account, and you want to make sure that your portion of the joint account isn't more than $250,000, and then you could have one or more trust accounts, but your portion, based on the number of beneficiaries, doesn't exceed more than $250,000 per beneficiary, with a maximum of $1.25 million. If you have more than that, then what you do is just split it up, do the exact same thing, but put some at another bank because it's per person per bank. Okay, that's number one, right?
That's interesting. That seems like it would be to the detriment of the bank, though, which is kind of ironic.
Well, it is because remember, this isn't the bank rule; it's a government rule.
Yeah.
Right.
Exactly.
Nothing the bank would like more than to say the FDIC has unlimited coverage on our business.
Okay.
So that's the first thing that you can do, right? The second would be inside the bank that you have. Just understand these three categories of the trust, the individual, and the joint, and you might just split up how you name the accounts to make sure you get maximum coverage inside one bank.
Okay. Are there other options?
Those are the two biggies that you would want to do. The big takeaway from this is make sure you get with your bank and make sure you're crystal clear that your accounts are covered to the extent you think they are.
Right.
Or get with your financial professional. They can kind of walk you through the options. Well,
Dave, it seems to me that this would warrant a call to your office by a lot of folks listening to this podcast today who may need a further explanation on all this kind of thing. I'm not even sure I'm clear on it after we've talked here, and it seems like this is just one example of the many reasons why everybody needs a good financial advisor.
Yeah, I think it is. And it's challenging in a little way for both of us, I think, Ron. And some of these concepts, it's just sometimes a lot of garbly-gook. Would that be fair to say?
Yeah, exactly.
And a lot of information and a lot of legalese. And it's if you're listening at home, it's not you that can't understand it. It is complicated, and I would argue maybe intentionally so.
Yeah.
But that's why you don't want to go at this alone, right? It is a lot of information, whether we're talking about FDIC or rules of how retirement accounts work and taxation. You can't afford to just wing it and hope this works out. Get with your financial professional. You want a coach on your side. You want to embrace this idea that you don't know what you don't know. So have somebody else, a second set of eyes, take a look at it with you, and to make sure you don't make a mistake that 10 years from now you're going to regret, and it's too late at that point to fix it.
So you could just blindly follow along and do things the way that you always have and just kind of ignore all these changes without consulting a financial advisor. And then it may end up costing you thousands and thousands of dollars. So I would imagine that, there's a big incentive for calling you right away.
Yeah, I would encourage that.
Thank you so much for explaining all this. It can get rather complicated, and with a regular conversation with you, you kind of keep it all straight for us. So we appreciate that. And I guess we will talk about another topic on our next podcast. We appreciate your being with us today. Remember, as we always say, income, legacy, growth, it's all right here at ILG Financial, and it's about helping you plan for retirement your way so you can achieve your financial goals. You can call ILG Financial at 540-720-5656 or go online anytime to ilgfinancial.com to learn more. And you can talk with Dave Lopez or Chase Lopez at ILG Financial. ILG Financial, of course, ilgfinancial.com is the website address. This has been the Retire Your Way podcast with Dave Lopez. I'm Ron Stutz. Thanks for listening. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.